edition of the Bourse Report. I'm Carissa Gobin, an investment analyst at Bourse, and I'll be filling in for Sarod this morning. Today, we're taking a look at the financial performance of energy-related company National Enterprises Limited and the conglomerate GraceKennedy Limited for its respective 3 months period ended 3 months and full year period ended December 31st, 2025. National Enterprises Limited, or NEL, reported improved earnings supported by higher dividend income, while GraceKennedy faced headwinds stemming from the impact of Hurricane Melissa in Jamaica. So firstly, let's take a look at National Enterprises Limited, or NEL. So NEL reported an earnings per share of 8.7 cents per share in the current period, Q1 of 2026, advancing 16.1% year-on-year. NEL's primary operating driver, dividend income, grew 19.4% from 42.8 million to 51.1 million in the current period. NEL's change in fair value of assets amounted to 0.7 million, down from 0.9 million in the prior comparable period. Overall, total comprehensive income before expenses grew 16.1% from 45.1 million to 52.4 million in the current period. Taking a closer look at the production and pricing landscape of some of NEL's key investments based on available data for the period October to August, natural gas production averaged 2.6 billion standard cubic feet per day, and pricing averaged based on Henry Hub US $3.21. Moving on to production of NGLs, the natural gas liquids, NGLs production increased from 5.3 million barrels to 5.9 million barrels. Ammonia, from a pricing and production perspective, remained relatively stable, and liquefied natural gas production advanced 14% from 14.96 million cubic meters to 17.12 million cubic meters as of the latest period. Looking at domestic energy prices as reflected by CBTT's Energy Commodity Price Index, prices have remained relatively stable from 2023 through January 2026. This follows a sharp spike seen in 2022, stemming from the Russia-Ukraine war that drove global commodity prices higher. More recently, though, ongoing geopolitical tensions stemming from the US-Iran conflict, which began on February 28, 2026, have led to higher global energy prices. So this could potentially benefit energy producers and may create a more favorable pricing environment for energy exporters such as Trinidad and Tobago. While the impact may not be as pronounced as the sharp increase seen in 2022, there may be some near-term upside to domestic energy prices. So looking at NEL's book value per share, NEL's book value per share continued its decline, reflecting its change in fair value of assets, moving from $6.89 in Q1 of 2023 to $4.32 in Q1 of 2026, with its book value remaining relatively range-bound from 0.5 times to 0.8 times before settling at 0.6 times in the current period. So NEL trades at a price of $2.55, up 33% year-to-date, and offers investors an attractive dividend yield of 11.4% on a trailing basis, up higher than its sector average of 6.2%. So while domestic energy production may remain relatively subdued in the near term, current favorable energy prices, along with NEL's strong financial position, could potentially benefit its investee companies and support near-term earnings and dividends for the group. However, over the medium to long term, several planned projects are expected to boost energy production in the domestic landscape. So on the basis of higher investee dividend income, higher global energy prices, and near-term uncertainty in energy production in the local space, Bourse maintains a market weight rating on NEL with a near-term positive outlook for the time being. So turning quickly to GraceKennedy Limited, or GKC. So GKC reported an earnings per share of 31 cents for the full year 2025 on a TT equivalent basis, down 17.6% year on year. Total revenue amounted to 7.98 billion, growing 6.4% year on year. Expenses rose 8.8%, reaching 7.76 billion on a TT equivalent basis. So total expenses, the rise in total expenses was partly due to one-off costs related to the impact of Hurricane Melissa in Jamaica. Profit before tax fell 16.7% to 461.9 million, and overall net profit attributable to equity holders amounted to 309.4 million. Looking at GraceKennedy's operating segments by PBT, all segments would have experienced a decline in the current period. Its food trading segments remain its largest contributor to PBT, accounted for 60% of PBT. The food trading segment would have fell around 11%, moving from 356 million to 318 million before eliminations in full year 2025. Its money services segment dropped 20% from 124 million to 99 million, reflecting a challenging operating environment driven by lower transaction volumes. Its banking and investment segment fell modestly from 46 million to 45 million, and its insurance segment profitability was affected by elevated insurance claims, with its PBT moving from 93 million to 65 million before eliminations. Turning quickly to GraceKennedy's profitability margins. Margins are on the lower end of the range as seen between fiscal year of 2021 to 2025. So operating profit margins moved from 7.5% in 2024 down to 5.7% in 2025. Profit before tax margins moved from 7.4% to a current 5.8%. So margins were affected by overall higher input costs across the group. So GraceKennedy trades at a price of $3.31 and trades at a PE ratio of 11.3 times, slightly above its conglomerate sector average of 10.8 times. It offers investors a dividend yield of 3%, below its sector average of 4.1%. On the basis of steady revenue growth, continued acquisition activity across the group, USD dividend payments, but tempered by lower profitability margins, Bourse maintains a market weight rating on GKC with a stable outlook for the time being. And that brings us to the end of this week's edition of the Bourse Report. For more information, please give us a call at 226-8773 or email us at info@boursefinancial.com. Thank you for joining us, and we'll see you next time on the Bourse Report.